The massive global build-out of artificial intelligence is consuming capital at a pace rarely seen in modern markets. But beneath that massive influx of cash lies a structural vulnerability. The hardware fueling this expansion is heavily concentrated, driving extreme imbalances across broad regional portfolios like the MSCI Emerging Markets Index. Just 3 companies, Taiwan Semiconductor, Samsung, and SK Hynix, have absorbed roughly 28% of that entire index. That is more than double the total weight of the Indian equities market combined. That means an entire regional asset allocation is physically parked in just 2 countries, Taiwan and South Korea. Almost all of that advanced fabrication and high bandwidth memory capacity relies entirely on a single metric, NVIDIA's current order book. For institutional allocators, this represents a single point of failure. One demand wobble or unexpected export restriction, and the entire regional market takes the hit. This is exactly where India recognized an opening. Instead of trying to instantly outbuild Taiwan in pure chip fabrication, the country is executing a state-backed pivot to subsidize the broader ecosystem. Through the India Semiconductor Mission, or ISM, the government is offering to cover up to 50% of the capital expenditures for approved facilities on a pari passu, or equal footing, basis. This graphic from the union budget outlines the immediate push. You can see an initial allocation of 1,000 crore rupees mapped out for the 2026-2027 fiscal year, specifically to fortify this domestic supply chain. Global markets responded to this fiscal magnet. This official document lists 10 major approved semiconductor manufacturing projects. Looking closely at Item 2, we find a Tata Electronics and Taiwan PSMC joint venture in Gujarat, representing a commitment of over 91,000 crore rupees. By absorbing half the construction cost of these highly complex facilities, the state deliberately lowers the barrier to entry. It signals to global capital that India is ready to absorb the overflow from constrained Asian markets. Manufacturing the hardware is the opening phase. The massive capital rotation is shifting toward where those chips operate. Fund managers call this a rotation into hard assets. In the context of AI, that means massive power transmission grids, specialized liquid cooling architecture, and high-speed telecom networks capable of moving massive terabytes of data without any latency. Global hyperscalers are actively laying this foundation. Microsoft outlined a $17.5 billion investment over 4 years. AWS committed over $8 billion, and Google is scaling up to a projected $15 billion footprint in the region. This chart maps out the raw physical scale of that build-out. India's data center capacity is projected to surge from roughly 1.5 gigawatts in 2025 all the way to a targeted 5 gigawatts by 2030. Because training large language models require intense hardware density, every conversation about artificial intelligence eventually turns into a conversation about securing heavy power and industrial real estate. To guarantee that these new hard assets see utilization, the Indian government is pairing its construction subsidies with strict legislative moats. Regulations like the Digital Personal Data Protection Act establish strong data residency laws, legally requiring tech companies to process and store specific types of digital information locally rather than exporting it to overseas servers. To soften that mandate, the state is deploying aggressive fiscal magnets, including total tax holidays for foreign cloud service providers who establish operations within the country between now and 2047. By combining half-price construction costs with strict localization laws and long-term tax breaks, the government anchors the physical foundation for the next 2 decades of digital adoption. So how does Wall Street actually trade a macroeconomic shift of this size? Institutional quantitative funds do not wait for traditional quarterly earnings reports to tell them a factory is built. They use what is known as alternative data to measure physical expansion in real time. Analysts deploy algorithms to scan high-resolution satellite imagery over subsidized sites, like the new fab in Dholera, literally counting the number of cement trucks and tracking steel deliveries to measure construction progress. They scrape global shipping manifests and customs data to identify the exact moment specialized imports, like high-grade liquid cooling pipes, start flowing into regional ports. And by monitoring local grid power draw, these funds pinpoint the exact week a new multi-megawatt data center powers up and becomes fully operational. In the modern AI trade, the movement of physical raw materials acts as a high-signal proxy for the future valuation of the technology itself. What initially looked like a penalty, India's absence from the pure semiconductor fabrication race, is actively being priced by these funds as a diversification advantage. This chart shows the domestic semiconductor market reaching an estimated $100 to $110 billion by 2030. The AI revolution depends on a synchronized, multi-decade sequence of subsidized silicon, massive power grids, and the quants who trade the movement of the raw materials.